Okay. Those of you who are licensed advisors, you can do many things with your license. You can do all types of insurance and you can do investments as well. So today we're going to cover RRSPs and we're going to cover FHSA. Okay. So retirement plans and saving up for a down payment for your first home. Those are the two accounts we're going to cover. So I see Karn is on as well, and Oksana, welcome. All right, let's get started with today's call. I'm going to share my screen. You'll be able to see what I see. There's a lot of activity. There's a lot of people doing either getting their license or they're making money. They're helping families. So that's a huge, huge thing. So number one, please have your notebook ready. We're going to cover RRSPs and investments. Very, very important topic today. Okay. So let's get into it. Number one, I want you to understand and recognize why investing is important. Okay. And I know people like Victoria and Dennis, it'll be your first time hearing this, but I really want you to understand what we do for people when we sit down with them financially. What are the things that we teach them and what do we guide them with? The number one rule about investing and the number one thing you want to understand is called the rule of 72. Okay. And I want you to write this down because understanding this as an advisor is so important. I'm going to give you an example of how this rule works. Let's say you're 29 years old today. And let's say you have $10,000 and you walk into the bank and the bank gives you a 4% rate of return on your savings. What this rule does, and the idea it gives you, is you take the number 72, you divide it by the interest rate the bank is giving you, and the answer you get is the number of years your money will double in. Okay, so I'll give you an example. 72 divided by 4 equals 18, which means every 18 years, your money will double. So you deposited $10,000. 18 years later, that 10,000 doubles to 20,000. And 18 years after that, it goes from 20,000 to $40,000. Now, my question to you is, what did the bank do with your money? What do they do with your $10,000? And the answer is they loan it out. And they loan it through car loans. They loan it through credit cards. They loan it through mortgages. They're taking your money, giving it to somebody else, and they're getting a better rate of return. And I'll give you an example of how powerful this concept is. Let's say the bank takes your $10,000 and they get a 12% rate of return. And your question might be, where does the bank get a 12% rate of return? Let me ask you a question here. What is the interest rate on your credit card? Anyone who has a credit card, can you tell me what the interest rate on your credit card is?
Around 5.5, 6, 12.
How much?
Around 5.5.
5.5 on some loans, like car loans could be.
Yeah, some
right?
loans, car loans, yes.
Some loans, yeah. Anyone else with a credit card? What's the interest rate on your credit card? Anyone?
Right now, interest rate by credit card 25.
How much?
25.
25%. So
yes.
Credit cards, they charge 19, 20, 21%, around there. So let's say the bank is getting a 12% rate of return. Okay, so 72 divided by 12 equals 6, meaning your money for the bank is going to double every 6 years. So look at this, that 10,000, 6 years later is $20,000. 6 years after that, 20 to 40,000, 40 to 80,000, 80 to 160,000, 320,000. At age 65, they have $640,000 from your money. And guess what? When you retire, you're going to get $40,000 and they're going to have $640,000. They're going to keep $600,000 from you. And it's the same money, the same amount of time, The only difference is a lack of education, a lack of financial education. Okay. And my question to you is, where do most people have their money sitting? They have it in a checking or a saving account, and it's over here. Okay. And what we do for people is we can help them get a rate of return like this, give them a better rate of return. Right. And my question to you is, how many people want to see a better rate of return? And I would say a lot of people do. Okay. So let's get into it. What are the different accounts and how do they work? Okay, so we're going to talk a little bit about RRSP. I want you to write this down in your notebook. This year, the deadline to buy RRSP is March 3rd. March 3rd is the deadline to buy a RRSP. Now, what does a RRSP stand for? It stands for Registered Retirement Savings Plan. Okay, now, there's a couple of benefits over here a RRSP gives. Number one is tax deferred growth. Not tax free, is tax deferred, meaning you're not paying taxes today, you're paying them when you retire. Okay, so what's the benefit of this? Let's say your tax rate today is 30%. Okay, you would pay pay the taxes on 30%. When you retire and your income goes lower, maybe your tax rate might be 15%. So you're going to pay taxes on the 15% rate later on. So tax deferred. Okay. Another incentive here is home buyers plan. There's been an update. You can no longer take out $35,000. You can take out up to $60,000 for the RRSP home buyers plan. Okay, meaning you can use that money for a down payment on your house. Remember this, you have to give that money back over 15 years back into the RRSP as well. Another thing is there's tax credits over here as well, and there's a lifelong learning benefit as well. So I'm going to get more into detail with this as well. Okay, now remember, March 3rd is the deadline. Eligibility, okay? Right here, Canadians can contribute to a RRSP up to the end of the year they turn 71 years old. As long as they're before 71, they're able to put money into an RRSP, okay? And withdrawals must start when you turn 72. Very, very important, okay? So a couple of different things. The limit for this year is $32,000. That's the limit, or up to 18% of your income. Okay. And if you put in more than you're able to contribute, you will get charged a penalty of 1% per month if you over contribute. Okay. So there's many benefits here. You can open a RRSP like a spousal RRSP. If your spouse's income is lower than yours, you can use that benefit of a lower tax bracket and open a spousal RRSP. The home buyers plan, you can use this money to put a down payment on a home as well, up to $60,000. And you have a lifelong learning plan over here. You can withdraw $10,000 a year if you're going back to school out of this plan as well. Okay. So there's another, I want to show you examples over here as well. So let's say this is an example of a person earning $45,000 a year, and they buy a RRSP of about $5,000 this year. Okay, their marginal tax rate is 22.7%. To this year, if they bought $5,000 of RRSP, they would save about $1,100 in taxes. Okay, meaning they would get that back. They wouldn't pay that to the government. They would get that as a tax credit. Okay, now there's another example I want to share with you. This person is earning about $80,000 a year, and they're putting in about $15,000, buying $15,000 worth of RRSP. Their tax rate is 28.2%. 28.2% of $15,000 is $4,000. They would save this year in taxes about $4,000 if they bought $15,000 of RRSP. Okay. So my point being here is everyone's situation is going to be different. Okay. Their income will be different. Their tax rate will be different as well. I'm going to show you a tax calculator. Okay. Those of you who are licensed, I want you to write down this website. It's called ia.ca. This website right here. If you're an advisor, you already have access to it. I'm going to share my screen. Sorry. You already have access to it, ia.ca. And under ia.ca, you go to My Tools. Can you guys see it? Can you give me a thumbs up if you can see my screen? Okay, perfect. All right. So Dennis, I see you. Okay, so if you go to My Tools, if you go down here, there's something called financial calculators. And you have access to all of these calculators as an advisor. You can look at savings, investment income, inflation, tax rates. What I want you to look at is the RRSP tax savings. So over here, we can choose our province because every province has a separate tax bracket and rate. If we look at British Columbia, and let's say our income is $80,000. And let's say we buy RRSP of, so let's suppose $20,000 for this year. You can show your client right off the bat that they would save about $5,000 in taxes if they were to contribute that much to their RRSP, retirement savings plan. Okay, so you have access to many of these calculators if you are licensed and if you're an advisor. If you're not licensed, you're not going to have access to it until you're not licensed. Okay, so let's get back into it right over here. I'm going to give you guys a little bit of an idea. We're going to talk about another account. This account is called the FHSA. And I want you to write this down. It stands for First Home Savings Account. The government came out with this account last year and about 2 years ago. And the benefit of this account is to save up for a down payment for your first home. Okay. So a couple of ideas here. To open this account, you must be a Canadian resident and at least 18 years old. You must not have occupied a residence that you own within the last 4 years. Remember, so even if you owned a property a long time ago, it will reset and you're able to purchase a home using this account too. You can do contributions of $8,000 annually into this account. And of course, unused room can be carried over and you can contribute up to $40,000 for the lifetime of this plan. If it's a spouse, you're married or whatever the case might be, it's $40,000 each. So you and your spouse can save up $80,000 for a down payment in this account. Okay? So the account must be closed 15 years after you open it. So if you open this account this year, you have 15 years to save up for a down payment, and then you must use the money in this account. If you don't, it can be transferred into a RRSP. So your RRSP can be transferred into this as well. Now, we talked about two accounts, RRSP and FHSA. I know you might be confused about these accounts, but I'm going to give you a simplified version. All you need to understand is what happens when I put money into the account, what happens when the money grows in this account, and what happens when I take money out of this account. Okay, so I'm going to show you guys all of these accounts and I'm going to give you an idea of how they work and you'll be able to understand which one benefits you more. Okay, so if you're in a non-registered, you have a checking saving account, when you put money into that account, nothing happens. Meaning you don't get a tax write-off, nothing really happens. But every year that money grows, it's called capital gains. 50% of the growth is taxable and 50% is tax-free. A lot of people don't know this because in your checking saving account, the money's not even growing. There's no growth there anyways. So you don't see this tax bill either. When you take the money out, nothing happens. You don't get a benefit, you get all your money out, whatever the case might be. Now, the RRSP, when you put money in, let's say I invested $10,000, I get a tax write off. Meaning, if my tax bracket is 30%, 30% of 10,000, that year I'll get $3,000 back from the government. I save in taxes $3,000. This money stays in this account and it grows tax deferred till I'm age 65. When I take that money out, it is 100% taxable. So if this 10,000 grows to $20,000, I pay 100% taxes on this. It becomes my income. Okay? So maybe it's a good account or it's not. All right? So another thing is TFSA, tax-free saving account. When you put money in, you don't get a tax write-off, but the money grows tax-free. And when you take it out, it is 100% tax-free. So that's a very good benefit. I believe everyone should have a TFSA, should have a tax-free saving account. Another account, the FHSA, it has both the benefits of a RRSP and a TFSA. So when you when you put money in, you get the same tax write-off as the RRSP, meaning you get your taxes back, that 3,000. It grows tax-free, but if you take it out and you use it for a down payment, it's also tax-free. So if your goal in Canada is to buy your first house, I highly recommend everyone should have a FHSA open. It is more beneficial than even the RRSP. So 2 accounts I recommend, a TFSA you should have, and a FHSA you should also have open to benefit you as well. Now, these accounts you can open in a bank, or you can open it in a checking saving account, whatever the case might be. You're not going to get much of a return there. I want to show you over history. $10,000 invested in US equities. I want to ask you a question. If you took $10,000 in 1981 and you put it under your mattress, how much would that money be worth today? Zero. It would be $10,000 wouldn't get you much. Okay? Remember this. $10,000 in 1981 would buy you a brand new car. Okay? Today, a brand new car is minimum $40,000, $50,000. Right? So you're losing the value if it's just sitting around. If you invested that money in US equities, today that $10,000 would be $850,000 with an average rate of return every year of 11%. What do you want to have? You want $10,000 or $850,000? Right? You see, wealthy people in Canada have financial advisors to teach them these things, that you must invest your money to grow your wealth. The average Canadian, I'm going to ask you, when is the last time you sat down with a financial advisor? Right? You have a doctor for your health, right? You have your insurance guy for your car insurance. How many people have a doctor for their finances or a financial advisor? They don't, right? So they never ever get to learn these things. So I'm going to give you an example here. Where can I get a rate of return like this? Over the last 10 years, this account is by Fidelity. And by the way, those of you who are licensed, all of you have access to this. Over the last 10 years, this has returned 10% every single year. Net fees, 10%. This account right here, over the last 10 years, has returned 17.9%. You're invested in Apple, Amazon, Microsoft, Tesla, all of these companies. And as they grow, your money also continues to grow as well. Okay? So very, very important to understand. Now, remember this. I want to share this example with you. $300 in the bank at 3% in 30 years will be $174,000. The same time, the same investment, 300 at 12% over the same 30 years is going to be $924,000. This is a difference of $750,000. $10,000. Okay. A lot of you on this call, you know people that already have TFSAs, they already have RRSPs, but they don't understand, is their money growing or is it not? Very, very important. Those of you who are licensed, you should be sharing this education as well. So I know I'm going to have Juliana on as well, and she's going to be sharing some questions. She's very, very experienced, senior marketing director as well. And Juliana, take it away. Go ahead.
Good evening, everyone. And today is probably one of my favorite topics because it's all about money and especially retirement. And the question I'm gonna share with you guys, I implemented before, and even today I was asking the key questions to some of the client. And this is really, really important because whatever we sharing information about individual account and so on, it's so difficult to keep it in the mind and separate how each account works and all of this. But you could really easily remember a few key questions to each account, and also you can implement those questions when you have a conversation with some of your friends or coworkers, or let's say someone, I don't know, neighbors. So the people that around you, you can ask those questions. And one of the questions that actually I today asked one of a potential client, and I asked simply like, did you receive your tax statement? So some of you that have a house with property, you aware there's a property tax, correct? So a lot of people start receiving those letters to pay the property tax, right? And they think that's the only tax they're gonna pay, right? And when they share, oh, you know what, my property tax went up because of assessment, so and so, you can ask about, well, you know that you can defer those property taxes, but I don't know if you're eligible, okay? So that's one thing that people can do if they're eligible. And then second, they never heard about, by the way. Second, a question that I ask, by the way, do you know how much money do you need for your retirement? Right? Do you know your financial independent number? So we short away, we say FIN number, which is financial independent number. How much money do you need for your retirement, right? And they thinking, oh, I don't know, right? So then you ask a question back, you know, your income is, let's say, 100,000. I give them example. So let's assume, so maybe for next 10 years, you're gonna retire. So you probably need at least 1 million. Are you agree? And the clients say, yes, probably 1 million in 10 years. That's probably, what if it's not enough? So you should invest that $1 million if you think you need $1 million to retire. What if you live too long? Do you have longevity in your family? And they're like, yeah, I have people live 80, 90 years old, right? So then you should think about retirement. So that's how it can lead to the conversation about retirement accounts, right? And those are the key questions that I ask even before I open the subject about the money. And do you remember there's a tax season started, right? Everyone need to pay taxes. Did you take advantage of reducing your income tax for last year? And they are like, what do you mean? Well, did you hear about RSP account? Did you take advantage of maximizing your contribution room? Right? And third question you can ask, did you review your RSP growth? Did you check with your financial advisor that your RSP were growing well enough for last, whatever, 5 or 10 years? They're like, what do you mean my RSP growing? Well, by the way, your RSP has to be invested, right? And has to have an investment portfolio in order to grow. So you clarifying, because most of the time they have no idea that for some reason the RSP has to grow, or for some reason this account have to work like this, or give a return, or so on. So you clarifying simple wording that, oh, those money has to grow, they have to be invested somewhere, right?
Even
So,
Juliana, I was gonna mention here as well that everybody saw the difference between your money growing and not growing is $750,000. So everyone should be asking that, hey, is your money actually growing, or is it just sitting in the bank and a checking saving account, whatever it might be? Yeah.
Yes, so that's 3 to 4 questions you can ask about retirement plan, and also about FHSA account. I want to add that this is the easiest way to start conversation. It cannot be easier than that. Anyone that come to Canada, first things they want to do, they want to buy a home, right? So the question you can ask, oh, I know you new to Canada, or maybe you've been here so and so, you're probably planning to buy a house. Everyone will say yes. And you just move your head, you say you probably want to buy a house like everybody else. Yes. So did you hear about FHSA account that gives a great benefit to people that would like to buy a house? Did you take advantage of deducting your income tax, as well as you will able to take those money tax free? Did you hear about this account? Well, that you should register this account. You should have one if you're planning to buy the house, right? So you should come up with certain plan if you want to buy a house, and if you want to save money for down payment, because everyone needs down payment. So with those simple questions, you can make a person think about, and you can actually observe when clients go in their head and like, oh yes, I need 1 million to retire my age, and also I need saved up money for down payment. You know what? You can respond back. You know what? It seems like you don't have a lot of information you knew, and maybe you need more information in regards to what I will mention. Let's schedule an appointment, and let's see how I can help you, and how can I give you more information in regards to those accounts. So that's all that I
Awesome.
want to mention, Par.
Thank you, Juliana. Everyone, before we end off, I want to mention some of you are licensed, which is amazing, meaning you're able to make money in the financial industry. Some of you are very, very close to being fully licensed, and I'm excited to get you guys started up as well. Those of you who are not licensed and you're studying for your course, you're studying your exams and so on, if you need help, reach out to your trainer, okay? But other than that, get your license. This is probably the best time. We're entering a recession in Canada, and I think it's the best time to get your license, start something part-time. Everybody out there in Canada, look at the cost of living, look at the cost of groceries. Everything is moving up. My question for you is your income moving up as well? And the answer might be no. Okay, so those of you who are not licensed, make sure you study and get your license. Those of you who are licensed, reach out to your trainer, learn the products, and get out there and help a lot of families. That's our goal. That's what we do. The education we share, the banks are not sharing any of this information. Okay, and this is something that's very, very important. So that's it for tonight. Tomorrow in our office, we have our training, okay, with Peter Johal, 7 to 8:30. Put it down in your calendar. Everyone should be in the office tomorrow. If you want to grow, if you want to build your business, and you want to build your income, make sure you're in the office tomorrow as well. So good night, everyone. I hope you guys learned something today, and I will see you guys all tomorrow or on Zoom as well. Okay, so good night, everyone.